There is a number on your screen this morning that the people who tell you what numbers mean are not telling you what this one means. Silver, the metal that has gained more than 122% over the past 12 months, the metal that touched an intraday all-time high of $121.67 on the 29th of January, the metal that sits inside every solar panel and every server rack and every electric vehicle battery management system being manufactured on this planet at this moment, closed Tuesday at approximately $73.78 per troy ounce, down 5% in a single session, down more than 7% over the last 30 days, up 122% from where it sat 12 months ago. 3 numbers, 3 time frames, 3 different stories. And not one of them is being explained to you with the structural honesty the data actually deserves. Stay with me, because what is happening this morning, in the hours before the Federal Reserve releases the minutes from its most divided monetary policy meeting in 34 years, is not noise. It is signal. And the signal is being deliberately buried under the louder, easier story about a possible Iran deal and an inflation print that was, in the polite phrasing of the Bureau of Labor Statistics, slightly hotter than expected. Slightly hotter than expected is the bureaucratic English for an inflation tape that just locked the Federal Reserve out of every dovish exit ramp it had been quietly hoping to use. Begin with what actually happened Tuesday. At 9:15 Eastern, silver stood at $75.69 per ounce. By the close, it had cratered to $73.78. A 5% session loss arriving on a day with no fresh catastrophe, no surprise central bank action, no breaking war headline. Just the slow, methodical grind of a paper market repricing itself for the possibility that the Federal Reserve, under the new chairmanship of Kevin Warsh, the most prominent monetary hawk in the modern history of the institution, may not cut rates at all in 2026. The CME FedWatch tool now assigns a 97.4% probability that the Fed holds rates at the current 3.50% to 3.75% range at the June 16th to 17th meeting. The probability of a cut at that meeting has collapsed from 48% to 2.6% in 6 weeks. The probability of a rate hike by December, which sat near 16% 2 weeks ago, has climbed to roughly 50%. That repricing did not happen because anything got better. It happened because 2 consecutive prints, April CPI at 3.8% year-on-year, the hottest reading since May 2023, and April PPI advancing 1.4% in a single month against a consensus near 0.4%, the largest monthly wholesale advance since March 2022, have effectively foreclosed any near-term dovish pivot. The Fed cannot cut into a tape like that without being seen as politically captured. Warsh, who took the chair on the 13th of May by the slimmest confirmation margin in the institution's history, will not be the man to inaugurate that perception. Now layer in the Iran story, because it is the variable doing the most work in confusing the broader narrative. On Monday and Tuesday, President Trump suggested there was a good chance of a nuclear deal with Iran, confirmed publicly that he had delayed a planned strike, and that Saudi Arabia, Qatar, and the UAE had urged restraint. Crude oil fell roughly 2% on those remarks. WTI sits near $111 per barrel this morning, off the $133 peak of last week, but still elevated by roughly 85% from where it traded before the war began on the 28th of February. The Strait of Hormuz, through which approximately 20% of the world's traded oil flowed before the war, remains operationally constrained. The Iranian parliament speaker, Mohammad Bagher Ghalibaf, who labeled the previous American framework Operation FOMC and declared, "Operation Trust Me Bro has failed," has not walked back any of that language. The ceasefire, in the president's own words spoken in the Oval Office, remains on massive life support. And yet, the market is choosing this week to price an Iran resolution into oil, into the dollar, and into precious metals. Silver, exquisitely sensitive to dollar direction and to the inflation expectation channel through which energy prices flow, is paying the price for that optimism, while the structural physical scarcity underneath it does not move by a single ounce. Here is the divergence that should stop you cold. Just 8 trading days ago, on the 12th of May, silver futures closed at $87.20 per troy ounce, a fresh 2-month high. 8 sessions later, silver is at $73.78. 7 consecutive months below the threshold is not an anomaly. It is a regime. In January of this year, in a single week, 33.45 million ounces were physically withdrawn from COMEX registered inventory. Roughly 26% of the deliverable pool, gone in 7 days. The price action since then has been brutal in both directions. $121 down to $67, back to $87, now to $73. Through all of it, the registered pool has not been meaningfully refilled. The eligible to registered conversion that the orthodox view assumed would happen at higher prices has not happened at the pace required. The owners of physical silver have not been willing to release their metal back into the deliverable pool, even as the paper price climbed to $121 and back down to the low 70s. That inertia tells you what the price action does not. It tells you the institutional posture is accumulation, not distribution. If this is the kind of structural read you have been searching for, the kind that follows the data into the parts of the market most television commentators do not bother to look at, then subscribe right now and turn on the notification bell. The FOMC minutes drop in a matter of hours. The PMI data lands tomorrow. The University of Michigan inflation expectations land Friday. The people who manage to keep a structured framework in place while those releases come through are the people who navigate the next phase of this market with their conviction intact. The FOMC minutes from the April 28th to 29th meeting release at 2 p.m. Eastern this afternoon. They will be parsed for one thing above all else: the language used by the 4 dissenters who voted against the consensus to hold rates. That 8-4 vote was the most divided FOMC outcome in 34 years. 4 governors and regional presidents who believed the policy posture was wrong. If the dissent reads as hawkish, 4 voices arguing the inflation tape is too hot to maintain even a neutral stance, the dollar strengthens, real yields climb, and silver faces another leg of mechanical pressure. If the dissent reads as dovish, 4 voices arguing that Hormuz and energy-driven inflation are exogenous shocks the Fed should look through, the dollar weakens and silver gets a bid. The market is not positioned for either outcome with full conviction. Thursday brings initial jobless claims and flash composite PMI readings. Friday brings the University of Michigan preliminary May consumer sentiment reading. The April final printed at 48.2, the lowest reading since the survey began in 1952, 74 years of data. The most frightened American consumer in the entire history of the measurement. If that number breaks lower, with the inflation expectations component printing above the 5-year median, you are looking at a deeply uncomfortable set of conditions for any Fed trying to argue that the inflation regime is anchored. The forecast spread on the sell side tells you the analytical community itself is fragmenting. HSBC, on the 18th of May, raised its 2026 silver price forecast to $75 per ounce, up from $68, while warning that upside is limited. JP Morgan's full-year average sits at $81. The Reuters median is $79.50. ING is at $78. UBS recently cut its year-end target to $80, citing demand destruction in photovoltaics as LONGi Green Energy and ICO Solar commercialize copper paste-back contact cells and silver-free heterojunction cells. The substitution story is real, and the bear case rests on it. And yet, on the high end of the same forecast distribution, Citigroup targets $110 for the second half. Bank of America has issued a scenario range of $135 to $309 based on gold-to-silver ratio compression. The spread between the bearish institutional view, anchored in the mid-70s, and the bullish institutional view, reaching toward $300, is the widest dispersion silver has seen in modern forecasting history. A unanimous market is a market with consensus. A market with this fragmentation is one that has not yet decided what it is. and markets that have not yet decided tend to resolve violently in one direction or the other. The Silver Institute's World Silver Survey 2026, released the 15th of April, projects a global supply deficit of 46.3 million ounces for this calendar year. That is the sixth consecutive annual structural shortfall. Since 2021, approximately 762 million ounces have been drawn from above-ground commercial and investment stockpiles, a fall of approximately 15.4% in roughly a week and a half. The CME has not raised margin requirements. No major Western refinery has come back online. China has not lifted its export licensing regime imposed on the 1st of January. Mexico has not removed its raw silver export restrictions. Peru, the second-largest silver-producing nation, remains under its formal national energy emergency declared on the 11th of May. Nothing structural has changed in 8 sessions. The price has changed by 15%. The paper market is moving on monetary expectations and currency repricing. The physical market is sitting where it was. And the question you should be holding in your mind is which of those two markets you actually believe is telling you the truth. The gold-to-silver ratio has widened from roughly 55-to-1 last week to approximately 61.2-to-1 this morning. That move tells you silver is being treated, in this short window, as the industrial commodity component of the precious metals complex, rather than the monetary metal it has been throughout human history. Gold, sitting near $4,489 per ounce, has been comparatively resilient because central bank balance sheet flows continue. The People's Bank of China added 8 tons of gold reserves in April, the highest single-month addition in 15 months, the 17th consecutive month of net buying. The World Gold Council confirmed global gold demand reached a record high in the first quarter of 2026, rising to 1,230.9 tons, with bar and coin demand alone at 474 tons, the second highest quarterly figure on record. The institutional bid under gold is structural, sovereign, and ongoing. The institutional bid under silver, in periods of monetary tightening, is more episodic, more leveraged, and more easily knocked around by the macro tape. That is the bear's argument for the divergence. It deserves to be sat with rather than dismissed. But here is what the bear case cannot explain. The COMEX registered silver inventory sits this week at approximately 76 to 80 million ounces, depending on the daily report. The coverage ratio, the percentage of paper claims actually backed by metal in the deliverable pool, has held in the 13 to 14% range for 7 consecutive months. Exchange analysts flag below 15% as stress territory. There's a question worth sitting with. If the structural physical scarcity is as severe as the data suggests, why is the price not higher? Why did silver crash from $121 to $67 in February and March? The honest answer is that the paper market is enormous. The futures complex is highly leveraged, and the macroeconomic environment of a strong dollar plus rising rate expectations plus high real yields is genuinely punishing for a non-yielding asset. Silver pays no interest. When the cost of money rises, the math against owning it gets brutally simple. The CME margin hikes in January forced leveraged paper traders to liquidate in a self-reinforcing cascade. The hawkish Fed repricing removed the rate-cut fuel propelling the rally. The dollar strengthened sharply on energy-driven inflation fears tied to Hormuz. These are first-order mechanical forces capable of moving the paper price of any commodity by 30 to 40% over a window of weeks. They have done exactly that. They are still doing it this week. What can be said with confidence is what institutional behavior has been through the entire correction. The Sprott Physical Silver Trust, which holds fully allocated London Good Delivery Silver and Royal Canadian Mint vaults, continued institutional accumulation through the first quarter. The LBMA Vault Free Float has not structurally recovered from the October 2025 squeeze, when the one-month London silver lease rate surged from 1% to over 30% in weeks. The COMEX paper-to-physical leverage ratio runs at around 7.5 to 1 against a registered pool 64% smaller than April 2020. Russia has formally incorporated silver into its sovereign precious metals reserve program, the first major central bank reclassification of silver in modern monetary history. The data does not show institutional capitulation. It shows institutional patience. What the dominant narrative requires you to believe this morning is that the crash from $121 to $73 is a fundamental correction restoring a speculatively overvalued metal to its intrinsic value. What the data requires you to consider is that the crash was the result of three simultaneously applied mechanical forces: margin hikes, hawkish Fed repricing, and dollar strength from geopolitical energy anxiety, none of which altered the physical supply-demand balance by a single ounce. The vaults did not refill. The industrial orders did not cancel. The data centers Meta, Alphabet, Microsoft, and Amazon are building on a combined 2026 capital expenditure commitment of $715 billion, nearly double the prior year, did not stop requiring silver because the COMEX paper price fell. The solar panels deployed in the first half of 2025 at a 64% growth rate did not become unbuilt because the futures market repriced for a Fed pause. The paper market told a story about the physical market. The story was not the physical market. Three things to watch between now and the June 16th FOMC meeting. First, the FOMC minutes at 2 p.m. Eastern this afternoon. Pay specific attention to the framing of energy-driven inflation. Transitory exogenous shock is dovish framing. Persistent inflationary pressure requiring a tighter stance is hawkish framing. Second, the gold-to-silver ratio. It sat at 55 a week ago, sits at 61.2 today. Widening further into the mid-60s, while WTI holds above $100, is the bearish configuration. Compressing back toward 55 while oil holds is monetary demand reasserting itself, which has historically been the configuration in which silver outruns gold. Third, the COMEX registered inventory in the daily warehouse report. If that pool falls below 70 million ounces before the end of May, the coverage ratio drops below 12%. At that point, the arithmetic becomes genuinely tight. A single large commercial entity asking for delivery could stress the entire registered pool. When the coverage ratio hits single digits, the question of whether the system can perform shifts from theoretical to operational. None of this means silver runs to $135 in the next 60 days. None of this is a prediction, or a guarantee, or an instruction to do anything with your own money. The consensus is often right. The bear case has real arithmetic behind it. Monetary tightening is a genuine and durable headwind for any asset that does not pay a yield. The substitution story in solar manufacturing is real. The dollar may continue to strengthen if the FOMC minutes confirm the hawkish posture the market is already pricing. Each of those forces is capable of pushing silver lower from here before it pushes anywhere else. What this analysis is, and what it has always been, is a reckoning with structural realities that markets tend to ignore until they cannot. The Silver Institute has put the word era into the public record next to the phrase reduced stocks. The COMEX coverage ratio has been below the stress threshold for 7 consecutive months. The LBMA vault free float has not refilled. China, Russia, Mexico, and India are all moving in policy directions consistent with treating physical silver as a strategic resource rather than a freely traded commodity. The price you see on your screen this morning, $73.78, is a number derived from a paper market that has not yet absorbed any of those structural realities into its quote. Whether and when that absorption occurs is the question this market is actually answering. The answer will not arrive as a press release. It will arrive in the warehouse data, in the lease rate prints, and in the geographic premium spreads that are already telling you everything you need to know if you're willing to listen to them rather than to the financial television voices who specialize in not listening. Drop a comment below and tell me which variable you think the market has most severely underpriced this morning. The hawkishness of the FOMC minutes, the fragility of the Iran ceasefire, the depletion of the LBMA vault free float, the Chinese strategic accumulation, the fact that solar silver demand is being engineered downward at exactly the moment data center silver demand is exploding upward at a pace nobody in the orthodox forecasting community modeled 3 years ago. The argument is in the data. The data is public. Pull every source yourself and arrive at your own conclusion. And remember, this is for education and discussion only, not personal financial advice. I am sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind. What do you think? Is silver at $73 the start of a deeper consolidation, or the moment the physical market has been quietly waiting for? Drop your perspective in the comments. The sharpest argument for or against is the one this conversation needs.